Alright folks, first day of April. I promised you this video, and I appreciate you all giving me the opportunity to refresh and recharge and follow my personal beliefs. And I'm sure we'll be back with a new energized spring in my step. So we're going to be looking at general commentary around the indices, and then a lecture on institutional order flow in the indices. All right, so we're back at it again with the E-mini S&P futures contract. This is the June 2021 contract, and this is the daily chart. So right away, I want you to take a look at this price action and pause the video and try to determine what you see here and what stands out. Some of you never pause the video. You know who you are. So anyway, let's take a look at this. We have this low here and this high here. Okay, that's your dealing range. Now inside that dealing range, there's a few things we can look at. We can look at the volume imbalance here, the propulsion block here, which is also building support around this down close candle, which is a bullish order block. So we have this here, trading back down into it here, and then extend that out in time. You can see price hits that nicely. So if you look at the low and you measure that low up to the high, so I'm using on the fib this high and that low, this putting it out here so it's a little bit easier to see and referencing. So I'm just looking at that high to that low, and you can pull this up on your own chart and test what I'm showing you here. The 50 level here is our equilibrium. Anything at that price or higher is a premium market. Anything at that price or lower is a discount market. So we can see the market trades down into equilibrium, and as it's trading down, once it hits that, that's essentially saying it's at a discount. And then we have the order block. So you have the order block, equilibrium to discount, and the market's likely to trade to another level of premium. So if we have this level here and it's determined that it's 38.44 and a half, we can take that level and go down to a lower time frame. So we're looking at an hourly chart here, and I want you to study this and look how nice that reaction is right there. We have 1, 2 times it hammers it and then rallies away. Now, I don't know about you, but if you can trade things like this and it has this much response after that, that's exactly what I fell in love with trading and price action. Looking for these types of moves here. The real strong, reactive, punchy little moves that they don't waste any time. They get where they're trying to get to. And as a trader, you're always going to wrestle with that. Okay, it's always going to be, I want my trade to get to my target, so I'm going to get out of this trade. When you have to learn to endure it. And most trades aren't going to be like this. They won't be so punchy. They won't deliver right away. Now, obviously, this is an hourly chart, so every one of these candles is an hour. But you've been in trades just like I have, where sometimes hourly candles can feel like days or weeks. It doesn't feel that way when you're trading a market like this, where it has a real nice reaction and just goes and goes and goes. I want you to take notice of what's in this chart here. We obviously have sell side liquidity down here, this low, and this low here, which is relative equal lows. So what's resting below that? Sell stops. So they dive lower into the discount market there, which is that daily bullish order block at equilibrium to discount. So you can see they're running for those sell side liquidity. But once it does that, and if we're bullish, what does your mindset switch to? Chasing it going lower? No. You want to start looking in the marketplace for premium arrays. Where can it reach for? Right away, you can see there's a fair value gap here in the form of a sell side imbalance, buy side inefficiency. Trades up into that beautifully. I thought that stuff only works in Forex, Michael. Yeah. Also, we have buy side liquidity pools, relative equal highs, and then the old high back here. So we've already mapped out the premium arrays that the market could be potentially reaching to once it trades here. Okay, think about what I taught you last week in response to the scalping and how I internalize price action. Like when I'm entering, I'm thinking about where it's going to go. Before it even starts moving in that direction, I'm already thinking where the market is likely going to go to for liquidity or rebalancing. Same premise here. Yes, it's an indice, it's not Forex, but price delivers the same way. They all follow the same, it's like the same book. They all have a rule book. Okay, you have to do this, you have to do that, which is odd because if you think about it, they tell you, and I've said this many times, I make fun of all the time, that retail logic is, well, you have to have good sound money management because you're probably going to lose more than you're going to win. But if you have a real high reward to risk model, you're going to be able to pay for a lot of the losing trades you're going to have and be happy. And besides, price is random. That's what they teach. That's what every book says. And price is not random. The folks that offer the risk or take on the risk would never take on that risk if it was up to just randomness. Anyone who wants to argue that, I'm open for debates. But the point is this: when you strip it down and you look at the price action in any asset class, and you look at it through the lens I'm teaching you to look at it with, it's one thing to say, okay, you're walking down the road with rose-colored glasses and everything looks the same. If you want it to be that color and that way of seeing it. But that's essentially what indicators and retail logic is. They say it's supply and demand, it's Elliott wave, it's harmonic, it's classic support and resistance, it's continuation reversal patterns. Okay, every one of those is a religion. Just like they say I'm a cult leader, this isn't a cult, this is the truth. And when you're faced with the truth, if it's the first time being exposed to it, the first thing is you're going to argue against it and fold your arms and say, I'm not going to buy into this because it goes against the grain of what I've been taught. And even though I know what I'm seeing here makes sense if I take it at face value, you may not be able to see it before it happens, so therefore it's just hindsight. But you all now know what it's like to be around me, and we see these things before it happens, and it's consistent. So your mindset needs to adopt the same mindset that smart money has. If they are taking the market down here only to go higher, we don't enter and then worry. We enter, place a stop, and then manage. Does it run for this buy side liquidity? Yes. Does it do it quickly? Yes. Once it clears this buy side liquidity, does it retrace much? No. Runs even more. So what's the next line of defense for the bears? This high, then this high, then this high. Now, if you have these stair-stepping lower highs, I don't look at just the first one. That's obviously it's an objective for partials. But if it's going to go like this, like stair-stepping lower, just go to the highest one because it's going to aim there. It isn't going to be like, oh, the market's going to only take these stops and they're safe here, or they're safe, but this guy and this guy here with a stop loss, good luck on them. It doesn't work like that. The liquidity's here. And once it gets here, then you have this area over here to consider, and maybe even back here. So when the market trades down here, you're looking to be a buyer. But what do you build that buy on? Not that this isn't already enough. For me, that's enough. As it trades down into that bold-faced bearish candle, I could step right in there and be a buyer of that and feel confident with it. No problem whatsoever. But what if I was able to tell you that there's other mystical things that we can apply to your chart to show that there's a good reason for that to go higher? Would you be interested? If you're not, just turn the video off. Nobody's ever going to turn that video off. All right, so let's take a look at what I'm going to show you here in regards to that. So now we're dropping down into a 15-minute time frame. All right, so we can see a little bit more detail in here. And we're going to focus inside this little area right there. So every thing I show you, the perspective is inside of this box, okay? No matter what I do with the data, It's this area we're focusing on, inside that shaded area. What I'm doing here is I'm changing the S&P to a line chart. Okay, and you can do that by touching on the TradingView chart here on these three little dots, and you go into the settings and click on the symbol. On the price source, you want to set it to low. That's the only thing you need to change. You don't need to do anything else with anything on this window here. You're just changing the price source for a line chart, the low. Why am I asking you to set your chart to show a line chart on the low? Because the market's going down in a bullish environment. So what you want to be looking for is the measurement and the comparison of the averages, comparing their lows. Now you can do it with the actual candles, and that's fine. I'm going to show you what it looks like in this presentation, but you're going to see that it's visually pleasing to me, and also easier for you to see it when you build it on a line chart basis with the low. Now everything I'm saying here could be obviously reversed. If we're looking for areas to be selling, you would compare the price source high. So you're going to be comparing highs. And what I'm saying here will make more sense in a moment, but you're turning your chart into a line chart from a candlestick. You can do that with the settings on the chart on TradingView, and then set the price source to low. That means it's plotting the line chart on the value of every low that's formed. Every low formed on this 15-minute time frame is being plotted on a line chart, but only on the lowest value of that 15-minute candle. And we're doing the same thing with the Dow futures. You can see the Dow futures here. YM is the symbol, M for June delivery month, 2021 for 2021. And you can see the price action in here. It's the orange one, and all I did was set that the same way. When you hit the compare tab on TradingView, and I've showed this before, then you just click the symbol you're going to add, and I'll show you what it looks like here. When you click the compare tab, put on NQM2021, and it'll overlay that as well. And then make sure that you're showing the line chart on both the Dow, which is YMM2021, and the NASDAQ futures, NQM2021. And you're plotting all three of them, the E-mini S&P, the Dow future, and the NASDAQ futures. You're plotting them on the low with a line chart. Now anytime you put a compare overlay on, it's going to plot the overlay as a line chart. It's like a default, but you can actually go in and change this overlay to a candlestick chart too. And again, I'll show you what it looks like in a moment, but we're focusing inside this area right here. Now nothing jumps off at you, I'm sure, looking in here, but as we're trading into that low on the S&P, watch what happens. We're going to drop down into a 5-minute chart. Now as it drops lower, study that for a moment and see if you pick up anything. Pause the video. Really pause the video this time. Some of you just don't want to do it. Notice that we have this lower low here, and then we have the higher low here, and then the higher low here. It might be a little hard to see that, so I'm going to separate them a little bit. So now you can see that this is the NASDAQ versus the Dow futures contract. NASDAQ, you can see that over here with the little labels. NASDAQ makes the lower low, whereas the Dow says, nah, I'm not interested in making the lower low. It's diverging. So this is SMT, okay? If you look at the E-mini S&P versus the NASDAQ, NASDAQ went lower, E-mini S&P, a higher low. Now this is the logic that people have, and this is what I was being indoctrinated when I first started in the 90s, to believe that indicators tell you. The indicator diverges, that means that it's telling you the price is going to go the other way. And let me tell you something, I've lost lots of real money believing that garbage. It doesn't work. Sometimes, yeah, sure, okay, but it isn't because the indicator did it. It's when instances like this occur when the market is really on the underpinnings are slowly shifting to the opposite direction, then that stuff will work. And if it happens to be when an indicator diverged, well, there it is. Hallelujah. The indicator gave you something. But the indicator had no bearing on how the market itself delivered. In other words, if all traders predominantly lose, and it's a 90% losing battle, and they're all using these indicators and these retail logics, how is it that all of that stuff is believed upon when it works in their favor? Like the market somehow said, well, you know what, this is usually a loser's game and loser's mindset, but you know, it's in that 10% time window where we'll let them work it out and have a win. Do you realize how much of a stretch that is to believe that? It's nonsense. But nobody really sits down and argues it. They just nod their head and drink the Kool-Aid and go along like good sheep. And I just don't like to think like that. And it's offensive to me when I see people hold on to it and defend it. Even if they are profitable, to investigate things like this, it's profitable to do that. It's not profitable, in my mind, to hold on to retail logic. Despite anyone being in here that can say they are profitable with a retail mindset, I guarantee if you strip it down, your wins have the signatures that what I'm showing you here occurred at that time. And you may not have, like I didn't know when I was doing it. My wins were just simply because I was on side. When I was coming up and I got lucky, I was fortunate enough to be on the right side of the marketplace and only buying when it was oversold and buying bullish diversions when the market was already set to go higher. But this here is not an indicator. It's not an indicator at all. What you're measuring is the actual price against another price that is closely correlated. Think about Dow theory, because this is essentially what's being shown to you. Dow theory suggests that the averages must confirm themselves. If they're all going lower, they all should be making lower lows. If one fails to do so, that implies something going on internally that may cause a change in the tide, and the delivery will be most likely changing. It may be short term, it may be intermediate term, or it could be a long-term turning point. But what we're looking for is that little crack. And what's actually occurring here is the real accumulation that takes place when the market's trading down like this. The NASDAQ went lower, so that was viewed as weaker when all that was a deeper stop run. This was showing that the Dow was accumulating much more aggressively and unwilling to go lower. So there was more buying going on in the Dow at this moment. But the crack in correlation, how the markets work together, like how they go in tandem, they all trade down lower until we get to what? An area where they don't go lower together. Lower low, higher low. And then we have this little retracement. By itself doesn't mean anything. But notice that we're at the bottom end of that shaded area on that line that constitutes a discount market bullish order block on the daily chart. Then if you see this, that's like an X-ray view of what's really going on with accumulation and distribution. This is real accumulation. S&P has that higher low here, whereas the NASDAQ had that lower low here. So you can clearly see it, even though it might not be easy to see for you, but it's definitely these lows here for NASDAQ and these higher lows on the S&P. And then when you have that mindset, you can anticipate higher prices moving ahead, but based on a higher time frame discount array on the S&P. So it frames the logic. But once everything starts, even with this lower move here, once everything starts to move higher, then you can go back to just what I teach you as it is. Down close candle, which is a bullish order block, fair value gap, trades into the fair value gap here for NASDAQ, and then look what happens with NASDAQ. Then NASDAQ joins the party. This was your Q, no pun intended. The Q, that's NASDAQ term, but nonetheless, bullish order block here, optimal trade entry here. So if you want to be a NASDAQ trader, You may not see your buy here. It comes later, and then there it is. And look how much dynamic movement on the upside versus the S&P. Whereas S&P led early, NASDAQ had to come back and pick up their orders here. Then they joined it. So this is the NASDAQ stripped down. Here's those lower lows. The market rallying up. Here's that gap and that bullish order block. Here. Runs. The S&P 5-minute chart. This is your bullish order block. Price trades above it, comes back down in. Order block, buy. Optimal trade entry here as well. Runs up. Institutional order flow entry drill here. Rally. Fair value gap. Bullish order block. Buy. Boom. And rally. That buy is back here on a 5-minute chart. Goes up to the fair value gap here. The first level of buy side liquidity I outlined, which is the higher of the 3 consecutive lower highs. This is that highest one, the buy side liquidity. Look how they jam it up into that and into the fair value gap. This is not Forex, folks, but look how it's performing the same way, because I'm teaching you how to read the market. I'm teaching you the internals of price and how price is delivered. If you understand that, then you have no problem finding setups. You'll still have to manage your money and your emotions before you find profitability, but this is how you get there. In this area here, I want you to study this because this is now your homework. I will include this in next Friday's lesson. I want you to strip this down the same way I just did this one here. Do the same thing with this. Put your Dow, the NASDAQ, the same symbols, the same things that I showed you in this video. Write down the notes and pull up those markets and overlay it on top of the S&P 5-minute chart. And you're going to see the same thing occurring here. But I also want you to go back out to the higher time frame too and refer to why that also is an area where you would be looking to be a buyer anyway. But it has to come from the higher time frame. Just the lower time frame in itself is of no importance. There has to be a logic behind it and why it should have been a buy here. And I'll give you that when we get into next Friday's lesson. Until then, enjoy the rest of your week, and I'll talk to you then. Be safe.